Corporate finance practice problem using OneNote. Bond purchase on margin and then sold. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side. We're in the Practice Problems tab, then down in the 1625 Bond Purchase on Margin and then Sold tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will be mirrored in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we've got our information up top. We're going to go through the calculations then on down below, focusing on the new thing, which is to be the purchase taking place on margin. To get there, we'll do the calculation of a bond price. Note that we focused in on the calculation of bond prices in a prior section in more detail. So if you want to take a look at that in more detail, or you want to take a look at present value calculations in general in more detail, take a look at the prior sections. We're going to be tacking on the new thing now, here being the purchase on margin and what the impact of that could be when we then sell it at a later point in time. So information, we have the bond that was issued. We're going to imagine at $1,000, the coupon rate 9%, years to maturity are 20. We're going to assume that we purchased the bond here. So now we'll assume that we purchase it at a price of $1,050. So we bought it at the premium $1,050 and we paid cash of only 20%. So we paid or bought it at the $1,050, but on margin to some degree. In other words, the 1,050 times the 0.2, we only paid 210. We borrowed the rest of it and purchased it on margin, that being the 80%, and then we used the interest payments on the bond to pay the interest on the loan. In other words, we expect, because we have the bond now, that we're going to get interest payments of the 1,000 times the coupon rate, 0.09, which we can then use to pay off the interest payments on the loan. Obviously, the objective here being that we're hoping that it goes up in value, and the fact that we kind of leveraged our investment could be beneficial if it goes up. If it goes down, then it could be non-beneficial. It could amplify the gains or it could amplify the losses. So let's take a look at what happens. We're going to say then that there was a change to the market rate is now the 8%. So now we're thinking about selling the bonds at this point in time. So first we're going to calculate the bond price, what we think we could sell it for using that 8%. This is the thing that we'll go through a little bit more quickly because we've seen this in prior presentations. But so you can go there for if you want more detail on that. And then we'll take a look at the impact of that, what that will be in terms of what the results are with our investment. So we're going to say the current bond price is going to be the calculation of, and we'll have to figure out two things with the current bond price, usually the annuity, present value of the annuity, which would be the interest payments of the 1,000 times the 9% over the 20 years. And then we'll have the present value, the maturity value of the 1,000. So the first component, present value of the interest, looks like this in Excel, negative present value, the rate, now 8%, comma, number of periods, which we're going to say is 20, and then comma, then the payment, which is going to be the 1,000 times the 9%, the amount on the bond. That would be the $90. We present value that, we get the 883.63. Present value in the principal then, we're going to present value the 1,000 back, or, present value the 1,000 that we would get back. We got the present value, the rate, 8%, comma, number of periods is 20, and then comma, comma, because this is not an annuity, but present value of 1, future value then being the 1,000. So that's going to give us the 214.55. Adding those two up would give us the 1,098.18. So we paid $1,050 for it. It's now standing. We think we can sell it at 1,098.18. There's a gain there. So if we actually sold it, then it would look something like this. We got the sales price of the 1,098.18 compared to what we bought it for, 1,050. That would be a gain of the 48.18. However, we didn't actually really pay the $1,050 for it, you'll recall. That's what we bought it for, but we bought it for in part a leveraged amount, a loan of 80% of it. So if you just take a look at this, then you could say, all right, well, the difference, the change, we started at the $1,050 for what we paid for it minus the sales price gives us the difference of the 48.18. You can compare that 48.18 to the starting point, what we bought it for, 1050. That would give you a rate of about 4.59. Or you can compare, the gross profit percent, which would be we got 48.18 divided by the sales price 1098.18. That would be the 4.39%. But again, it's not really a good comparison if we think about the cash flow, because we only really paid the 1,050 times the 20%, 0.2 is for 210. So what's the gain in relation to the actual cash flow? We'd have the price of the 1,050, the 20% of that, that's going to give us our 210. And if I compare that then to the profit, that's going to give us the 22.94% return on cash investment. In other words, we have the 48.18 compared to the actual cash that we put in, 210. That's a 22.94% return on cash investment, which is pretty good, right? So we've basically amplified the return that we're going to get by leveraging the purchase by buying basically on the margin. Obviously, that can work out good if in the event of a gain. So if we think things are going to work out good, that it could be beneficial to do that. Obviously, the downside is that in looking for that amplification, we could amplify the losses in the event that there's a decline.